In 1984, a man in a small town in central Kenya had a dream. He had no investors, no bank backing him, no connections in the financial world. He had 5 employees and 5,000 shillings. That is roughly $40 today. With that, he opened a small building society in Kangema, Murang'a, a place most Kenyans had never heard of. The aim was to help poor farmers and small traders access money. 9 years later, the Central Bank of Kenya declared his institution technically insolvent, that it was dead on paper and done. Three men walked into CBK governor's office on a cold morning in 1993 to beg that the doors not be chained shut, and they were granted one last chance. Today, Equity Group Holdings has over 21 million customers across 7 countries. It is one of the most studied banking models in the world. Harvard teaches it, the World Bank funds it, and Forbes coined the phrase the Mwangi Model to describe it. And it all started with 5,000 shillings and a man who refused to give up. This is the story of Equity Bank. To understand Equity, you first need to understand the man who started it. Peter Munga, who was born in 1943 in Nyagatugu village in Kangema, Murang'a County, Central Kenya, the tea country, farming country, a place where nobody expected a banking empire to be born. Munga grew up poor. He worked hard, got an education, eventually rose to become a civil servant, an assistant secretary at the Ministry of Water. He had a stable job, a steady salary, the kind of position most people in his circumstances would hold on to for life. But Munga had the problem, a problem with a system he saw every day. The farmers around him, small scale, hard-working, honest people, had no access to credit. The big banks did not want them. To those banks, a smallholder farmer with no salary and no collateral, no formal employment was not a customer. They were a risk. So Munga resigned from his government job in October 1984. He founded Equity Building Society in Kangema town, not in Nairobi, not in Mombasa, but Kangema, with 5 employees and 5,000 shillings. The mission was simple: give ordinary Kenyans access to money, mortgage financing, term loans, deposit services. The logo was a modest house with a brown roof, a symbol of what the people he was serving dreamed of owning. For the first few years, things moved slowly, but they did move. Equity opened branches in nearby Central Province. People came, accounts were opened, loans were given. But by the early 1990s, the cracks had become craters. Kenya's banking sector in early 1990s was in crisis. Between 1992 and 1993 alone, the Central Bank of Kenya was forced to shut down, merge or place under statutory management over 20 financial institutions. Banks were collapsing across the country. People were losing their savings. Trust in local financing institutions was at an all-time low, and Equity Building Society was in the middle of the wreckage. By December 1993, the numbers were devastating. 54% of all loans on the books were non-performing, meaning customers had borrowed the money and they were not paying it back. Accumulated losses totaled to 33 million shillings. Capital had been completely wiped out. The institution had a liquidity ratio of just 5.8%, and the requirement was 20%. Worse still, Equity only had around 3,000 customer accounts, and of those, 3 single depositors held 85% of all the deposits. The entire institution was sitting on a cliff held by 3 people. The Central Bank of Kenya's ratio report was blunt. Equity Building Society was technically insolvent. Board supervision was poor. Management was inadequate. Deposits were being used to pay operating expenses. On a cold morning in early 1993, Peter Munga and 2 colleagues walked into the office of CBK Governor Eric Kutot. They were there to plead their case. The governor had the power to change the doors shut that day, but he did not. But he made it clear to them, fix this or we will. Munga went back and made the most important decision of his life. He brought in new blood. His name was James Mwangi. He was 31 years old, born in the same Kangema Highlands as Munga, grew up in poverty, put himself through school with sheer determination, trained as an accountant, and worked at Ernest and Young, then Trade Bank. He had already invested his own savings into Equity Building Society in 1992, urged to do so by Munga, a family friend, and had watched it nearly die. In 1993, James Mwangi joined Equity as the Director of Finance and Operations. What he found was a broken institution with a broken culture. Staff did not believe the company could survive. Customers had lost faith. The building was falling apart. Literally, management had no strategy. Mwangi's first move was not a financial one, it was a cultural one. He gathered the staff and told them, "We are not going to die. We are going to change what we are." He began training employees, teaching them to see every customer, no matter how poor, as someone with dignity, someone whose dream mattered. Then he attacked the strategy. His core insight was this: Equity had been trying to serve the poor using the same model as banks that serve the rich: minimum balances, high charges, complicated paperwork. That model did not work for the people Equity was targeting, so he threw it out. Equity would have zero minimum balance. Anyone could open an account: a farmer, a market trader, a mother in the village, with whatever they had. No monthly fees, no intimidating bank branches. Banking with a human face. The turnaround happened in 1 year. Harvard Business School would later describe it as one of the fastest institution turnarounds in African business history. Between 1994 and 2003, Equity's transformation was unlike anything the Kenyan banking sector had ever seen. In 1994, Equity had just 12 deposit accounts. By the end of 2003, they had 252,000 accounts. Customer deposits had gone from 115 million shillings to over 3 billion shillings. The strategy was radical simplicity. Open an account with anything. Borrow even if you have no collateral. Use your reputation, your community, and your character as security. Bank on wheels. They had mobile banking vans driving into remote areas that no bank branch would ever reach. While every other bank in Kenya was fighting over the wealthy, the rich, those with salaries and corporate jobs, Equity was signing up market traders, matatu operators, small-scale farmers, and village shopkeepers. The traditional banking world laughed at them. Industry colleagues called the model unviable. They said you cannot build a serious bank on poor people. Mwangi had a different answer. He said our colleagues in the industry ignored us, and that was our greatest gift. In 2004, Equity converted from a building society to a fully licensed commercial bank, Equity Bank Limited. In 2006, it listed on the Nairobi Securities Exchange. The IPO was oversubscribed. Ordinary Kenyans, the same people the bank had been serving for years, queued to buy shares. In 2007, a private equity firm called Helios Investment Partners invested 185 million US dollars into Equity. International money chasing an African bank built on a model nobody believed in 10 years earlier. By 2008, Equity Bank held 48% of all bank accounts in Kenya, nearly half the country banking with one institution. The bank that was declared dead in 1993 was now the largest bank in Kenya by the number of customers. But James Mwangi was not finished. The vision was never just Kenya. Mwangi's model was built on a simple truth. Africa had hundreds of millions of people who had never held a bank account, not because they didn't want one or because they did not need one, because no bank wanted them. Equity changed that in Kenya. Now it would do the same across the continent. Uganda came first in 2008, then Rwanda, Tanzania, South Sudan. Each time the same playbook: go where other banks won't go, serve the people other banks ignore. But the boldest move was Democratic Republic of Congo. In 2015, Equity walked into DRC, a country of over 100 million people where fewer than 1 in 10 had ever held a bank account, a country with decades of conflict, weak infrastructure, and a banking system that had barely scratched the surface of the population. In 2020, Equity merged its DRC operation with Bank Commercial de Congo, the oldest bank in the country, to form Equity BCDC, instantly becoming the second largest bank in the DRC by assets. In 2025, DRC operation delivered over 137 million US dollars in pre-tax profits in a single quarter, up 18% year on year. James Mwangi has said publicly the DRC could one day be more profitable than Kenya itself. Today, Equity Group has total assets of 1.7 trillion Kenyan shillings, approximately 13 billion US dollars, over 21 million customers, presence in 7 countries, and a stated goal of operating in 15 African countries by 2030. In 2024, the group reported a net profit of 48.8 billion shillings, up 12% from the year before. Forbes called it the Mwangi Model. Harvard made it a case study for first-year MBA students alongside Apple and Amazon. But the story of Equity is not complete without talking about what this bank does beyond banking. Peter Munga and James Mwangi grew up in poverty, both of them from the same hills of Murang'a, and both of them knew that the greatest barrier to escaping poverty in Kenya was not just money, it was education. So they built something else: the Wings to Fly scholarship program, fully funded secondary school scholarships for the Kenyans' brightest students from the poorest backgrounds, selected from every county in the country. Since it launched, Wings to Fly has given over 60,000 Kenyan children a secondary education they could have never afforded. Over 17,000 of those scholars have gone on to university. 900 of them have been admitted to international universities in 26 countries. Scholarships alumni have gone on to found medical clinics, start businesses, and mentor the next generation. One scholarship, one child, one family lifted 60,000 times. Now, no empire is there without its shadows. In 2024, Equity Bank lost 1.5 billion shillings, roughly 11.6 million US dollars, to an internal fraud scheme done by its own staff working with outsiders. When Mwangi found out, his response was swift and brutal. He launched a company-wide investigation. In a single day in May 2025, he issued termination notices to 1,200 employees. Over 287 senior managers and junior staff had already been fired the month before. His words to the press were unambiguous, and I quote, he said, "I will clean the bank and I will be ruthless. This is not a toll station." Critics urged the process was too aggressive, firing people in 48-hour ultimatums without fully due process, but Mwangi held his ground. There have also been questions about controversial land transaction involving Mwangi personally, a disputed 300 million shilling property purchase connected to the estate of former President Daniel Arap Moi. That case remains in the courts. Now, these controversies do not erase what Equity has built, but they remind us that no institution, however inspiring its origin story is, that institution is not beyond scrutiny. Peter Munga started with 5,000 shillings. James Mwangi walked into a dying building society and refused to let it die. Together they built a bank that the entire world now studies. They did it by doing one thing most banks refused to do. They looked at the people everyone else ignored and said, "You matter, your money matters, your dreams matter." That is the story of Equity Bank, one of the greatest business stories to ever come out of Africa. If you want more stories like this, subscribe, because on this channel we tell the stories that the rest of the world is not paying enough attention to. Africa is building empires and we are here to document them.